The pricing algorithms continued to function as designed. They reflected trading flows, option expirations, and liquidity conditions. They did not reflect the strain forming inside the settlement system. From a strategic perspective, this distinction is critical. Prices can remain stable even as systems weaken. Stress does not announce itself through volatility at first. It accumulates quietly within infrastructure. This event was not about forcing prices higher. It was about forcing accountability. The entity making the demand did not need to be correct about future prices. It only needed to be correct about one thing, that the physical system is far less flexible than the paper system. By requesting 25 million ounces, the entity consumed a majority of registered supply in a single action. That concentration alone changed the risk profile of the exchange. It reduced optionality. It narrowed the margin for error. It also introduced a new variable into the market's decision-making framework, precedent. Once one participant demonstrates that physical settlement can be demanded at scale, the psychological barrier is lowered for others. The system no longer rests solely on assumption. It rests on observation. Institutional risk managers understand this dynamic well. Financial systems are resilient until they are not. Failure rarely begins with collapse. It begins with behavior change. The filing of the delivery notice forced immediate internal reviews across clearing members. Exposure had to be reassessed. Inventory assumptions had to be rechecked. Contingency plans that existed only on paper had to be revisited under real constraints. None of this required public acknowledgement. It occurred behind closed doors. From the outside, nothing seemed different. The price closed where it was expected to close. Headlines remained quiet. Commentary focused on routine end-of-week analysis. But structurally, the market had crossed a threshold. This was not a squeeze in the traditional sense. It was not driven by short positioning or speculative leverage. It did not depend on momentum or sentiment. It was driven by settlement mechanics. A delivery squeeze is fundamentally different from a price squeeze. It cannot be resolved by volatility alone. It cannot be smoothed by options decay. It forces resolution through inventory, logistics, and legal performance. That is why it represents a strategic warning rather than a trading opportunity. For business leaders, investors, and policymakers, the lesson of this event is not about silver itself. It is about systems that rely on confidence more than capacity. When confidence holds, leverage is invisible. When confidence weakens, leverage becomes exposure. This delivery demand marked the moment when the silver market stopped being purely theoretical and became operationally constrained. What followed would not depend on opinion or narrative. It would depend on metal, documentation, and time. And time, once settlement is demanded, is no longer an ally of the system. The structure beneath the market. What made the delivery demand so dangerous was not its size alone. It was the structure it exposed. Modern commodity markets are not designed around the constant movement of physical goods. They are designed around netting. Contracts offset other contracts. Positions roll forward. Losses and gains cancel each other out. At the end of most cycles, very little needs to be physically delivered. Cash changes hands and the system resets. This design allows markets to function at scale. It also allows them to operate with extreme leverage. In the silver market, this leverage is not hidden. For every ounce of physical silver stored in approved vaults, there are multiple paper claims tied to it. Futures contracts, options, swaps, and exchange-traded products all reference the same underlying metal. The system assumes that these claims will never be exercised all at once. That assumption is the foundation. Registered inventory is often misunderstood. It does not represent a pile of silver bars sitting idle, waiting for buyers. It represents metal that could be delivered if required. Some of it is already earmarked for future delivery months. Some of it is pledged as collateral for financing. Some of it is tied to obligations outside the futures market. In simple terms, registered does not mean free. At 3:47 p.m. Eastern, silver looked calm. $76.20 on your screen. Nothing unusual. Another quiet Friday, right? But while you were scrolling, while headlines stayed silent, a single order hit the vault, not paper, real metal, not a bet, not a trade, a demand. 25 million ounces, physical, immediate. That one move just tested the entire system, and what it exposed cannot be unseen. Because when someone finally says, I don't want cash, I want the metal, the game changes forever. And what happens next could break the price of silver itself. Welcome to market metal. If you've lived long enough to see systems rise and quietly crack, this channel is for you. Subscribe, not for hype, but so you don't miss the truth when others stop telling it. And tell me this in the comments. Where are you watching from today? The event that changed the equation. At exactly 3:47 p.m. Eastern Time on Friday, February 6th, 2026, the silver market appeared calm. Screens across trading desks showed silver hovering near $76.20. Volatility looked low. The weekly close felt routine. For most observers, it seemed like it was just another ordinary end to the trading week. But beneath that calm surface, something fundamental had already shifted. Earlier that afternoon, at 2:14 p.m. Eastern, a formal notice was filed inside the commodities clearing system. It was not a rumor. It was not a forecast. It was a documented action. A single entity, still unidentified, had stood for physical settlement on 5,000 silver contracts. In the structure of the silver futures market, that number carries extraordinary weight. Each standard silver futures contract represents 5,000 troy ounces. Multiplied across 5,000 contracts, the demand totaled 25 million ounces of physical silver. Not cash, not a paper equivalent, not a deferred promise. Physical metal to be assigned, documented, and delivered according to exchange rules. This was not a trade designed to capture short-term price movement. It was a demand for settlement in kind. To understand why this mattered, one must first understand what almost never happens in modern commodity markets. The overwhelming majority of futures contracts are closed before delivery. Traders roll positions forward, offset exposure, or accept cash settlement. Physical delivery is rare because the system itself is built on the assumption that most participants do not want the underlying commodity. They want price exposure, not the asset. That assumption is what allows the market to function with extreme leverage. The silver market, like many commodity markets, operates on a structure where paper claims vastly exceed immediately available physical supply. This is not hidden. It is structural. The pricing mechanism depends on confidence that delivery will almost never be requested at scale. On this day, that assumption was challenged directly. Standing for physical settlement means more than simply holding a contract to expiration. It is a legal declaration. The buyer is asserting the right to receive warehouse warrants tied to specific bars of metal held in approved vaults. These warrants list serial numbers, weights, and vault locations. They represent ownership, not a promise. Once that process begins, the exchange and its clearing members are obligated to perform. At the time the notice was filed, publicly reported data showed that registered silver inventory across approved vaults stood near 41 million ounces. On paper, that number appeared sufficient. 25 million ounces requested would leave 16 million remaining. But the difference between registered inventory and available inventory is critical and often misunderstood. Registered inventory is metal that is eligible for delivery. It does not mean that it is free of claims. Portions may already be pledged. Some bars may be allocated to other contracts that have not yet matured. Others may be encumbered through collateral arrangements in financing markets. In some cases, the same metal may be referenced across multiple obligations due to rehypothecation. The system functions because these claims rarely converge at the same time. This event forced convergence. By filing for delivery, the entity effectively required the system to demonstrate that the metal exists, is unencumbered, and can be transferred. It transformed an abstract number on a balance sheet into a physical obligation with a deadline. That deadline matters. Under exchange rules, once a delivery notice is issued, the clearing process begins. The buyer is entitled to receive warrants within a defined window. This is not optional. It is not subject to negotiation. It is the foundation of contractual integrity. The immediate market price did not reflect this pressure. Silver did not spike. There was no dramatic move before the close. That lack of reaction was itself revealing. It showed the difference between visible pricing and invisible stress. The reason this has not mattered historically is behavioral. Market participants have been trained by incentives and by design not to ask for the metal. Taking delivery introduces complexity. Storage, insurance, transport, and security all become real issues. Cash settlement is easier. Liquidity is immediate. The system rewards convenience. Because of this, the market evolved into a structure where physical settlement became the exception, not the rule. That evolution created fragility. When the unidentified entity demanded physical settlement on 5,000 contracts, it forced the system to shift from abstraction to reality. Every assumption had to be tested. Every internal ledger had to be reconciled against physical constraints. This is where the tension began to build. Clearing members are responsible for ensuring performance. They do not simply pass orders through the system. They guarantee settlement. When a delivery notice is issued, those guarantees become active obligations. To meet them, clearing members must either already control sufficient metal or be able to source it quickly. Sourcing physical silver at scale is not like executing a trade. It involves logistics. It involves certification. Bars must meet specific standards. Vault space must be secured. Transport must be arranged. Each step introduces delay and cost. None of this is visible on a price chart. At the same time, the paper market continued to operate normally. Options expired. Futures settled. Algorithms optimized positions around expected flows. The price hovered near levels that maximized efficiency for market makers. This disconnect between surface stability and internal strain is common in complex systems before failure. Stress accumulates where it is least visible. Another layer of vulnerability lies in rehypothecation. In financial markets, rehypothecation allows the same asset to be pledged multiple times across different transactions. It increases liquidity, But it also increases dependency. If one claim becomes primary, others become secondary instantly. Physical settlement does exactly that. It elevates one claim above all others. When metal is assigned to satisfy a delivery notice, it cannot simultaneously satisfy another obligation. The moment it is earmarked, it is removed from the pool of available collateral. This creates a cascading effect. As inventory shrinks, remaining claims become riskier. As risk increases, margin requirements rise. As margins rise, leverage must be reduced. Reduction forces selling. Selling pressures prices. Prices falling create more stress. The system feeds on itself. Historically, exchanges have relied on behavioral patterns to prevent this sequence. They assume that only a small fraction of contracts will ever reach delivery. That assumption allows them to maintain ratios that would be unsustainable under full performance. The delivery demand challenged that assumption publicly. From a strategic standpoint, this is where suspense enters the system. Not emotional suspense, but structural suspense. The outcome is not determined by sentiment or narrative. It is determined by whether obligations can be met without triggering secondary effects. There are only a few possible paths forward once physical settlement pressure emerges. The first is performance. The system sources the metal quietly. It absorbs the cost. It delivers on time. Confidence is preserved, but at the expense of inventory depth. The next delivery becomes harder. The second is adjustment. Rules are changed. Limits are imposed. Settlement terms are modified. This protects inventory, but damages credibility. The third is intervention. Authorities step in. Emergency provisions are invoked. Physical delivery is suspended or deferred. This preserves the system temporarily, but admits structural weakness. Each path carries long-term consequences. The reason this event drew intense attention within institutional circles is that none of these paths are cost-free. Each reveals information the system prefers to keep opaque. For decades, price discovery in silver has been driven primarily by paper markets. Physical markets followed price rather than set it. That arrangement works only if physical supply is elastic at quoted prices. When physical supply becomes inelastic, price discovery shifts. The delivery demand forced that question into the open. It asked implicitly whether the quoted price of silver reflected the cost of acquiring actual metal at scale. That question is uncomfortable because it challenges the authority of the pricing mechanism itself. If the answer is no, then price becomes informationally weak. It signals liquidity conditions in the paper market, not availability in the real one. For businesses that rely on silver as an input, manufacturers, technology firms, energy producers, this distinction matters. Their risk is not price volatility alone. It is supply certainty. For investors, the implication is equally significant. Exposure to price without exposure to settlement risk is incomplete. The two are no longer separable. As this realization spread quietly through institutional networks, behavior began to shift, not publicly, not dramatically, but subtly. Risk officers reassessed assumptions. Procurement teams revisited sourcing strategies. Balance sheets were stress tested against scenarios that had previously been dismissed as improbable. None of this required headlines. The market remained calm because calm is what systems project when they are trying to preserve order. But beneath that calm, the structure had been stressed in a way it could not ignore. The delivery demand did not break the market. It revealed where it could break. And once a weakness is identified, it changes how every rational actor behaves going forward. That is why this moment mattered far beyond silver. It demonstrated that in a system built on confidence, the most powerful move is not speculation, but verification, institutional trap. By the time the delivery demand was fully processed inside the clearing system, the problem was no longer theoretical. It had become operational. Institutions do not panic the way individuals do. They do not react emotionally. They react procedurally. Risk committees convene, exposure reports are run, liquidity assumptions are stress tested. When something threatens the integrity of settlement, the response is quiet, but immediate. This was one of those moments. The demand for 25 million ounces of physical silver forced clearing members to confront a narrow reality. Their options were limited, and time was not on their side. Under normal conditions, clearing members manage delivery risk through inventory buffers, forward sourcing, and offsetting flows. One participant delivers, another receives. Metal moves on paper far more often than it moves in trucks. The system balances itself because obligations are dispersed. This demand was different because it was concentrated. A single claimant absorbed the majority of registered inventory in one action. That concentration removed flexibility. It turned a distributed risk into a focused one. The first institutional challenge was sourcing. Even if the metal existed somewhere in the system, it had to be made available, certified, and transferred within a fixed window. That meant negotiating with holders who had no incentive to sell quietly. In tight physical markets, sellers control terms. The second challenge was visibility. Any attempt to acquire metal at scale leaves a footprint. Brokers notice, vault operators notice, logistics firms notice, algorithms that monitor flow notice. The more urgent the buying becomes, the harder it is to disguise. Once urgency is detected, behavior changes. Other institutions begin to move ahead of the demand. They buy preemptively, not because they need metal immediately, but because they understand that someone else will. This is how shortages accelerate, not through fear, but through rational anticipation. The third challenge was price integrity. Paper prices are efficient only when marginal supply exists near quoted levels. Large physical purchases do not occur at posted prices. They occur across tiers. The first ounces may be sourced near spot. Subsequent ounces require concessions. Each layer costs more. This creates a divergence between quoted price and realized acquisition cost. If clearing members paid significantly above the screen price to source metal, they faced an uncomfortable accounting reality. They would be fulfilling obligations at a loss, revealing that settlement costs did not align with market pricing. That misalignment is dangerous for credibility. The fourth challenge was precedent. If one participant could successfully demand delivery at this scale, others could follow. The system could survive one event. It could not survive many. Each delivery reduced the pool. Each reduction increased the next buyer's leverage. This created a prisoner's dilemma inside the system. Clearing members wanted the issue resolved quietly, but resolving it quietly required cooperation from parties with opposing incentives. Some holders of physical silver had no reason to help. Others had strategic reasons not to. This is where the situation became unstable. Historically, when markets face this kind of structural stress, authorities rely on tools designed for emergencies rather than markets. These tools exist precisely because markets cannot always self-correct without damage. One such tool is rule modification. Exchanges reserve the right to adjust margin requirements, position limits, and settlement terms under extraordinary conditions. These adjustments are framed as risk management, but their function is behavioral control. They discourage participation that could worsen stress. Another tool is settlement flexibility. Cash settlement clauses, delayed delivery provisions, and alternative fulfillment mechanisms exist to preserve continuity when physical performance becomes impracticable. They are rarely used because they undermine trust, but they are used when the alternative is failure. The most severe tool is force majeure. Force majeure allows an exchange to suspend obligations due to circumstances beyond reasonable control. It is the legal acknowledgement that performance is no longer feasible under existing rules. Invoking it preserves the system at the cost of admitting limitation. Institutions understand the trade-off clearly. Preserving trust is more important than preserving formality, but trust, once damaged, does not recover quickly. This is why the delivery demand placed the system in a trap. If the exchange delivered successfully, it weakened future resilience. If it failed to deliver, it weakened present credibility. If it intervened, it signaled fragility. If it did nothing, it risked escalation. Every option carried downside. From a strategic perspective, this is the definition of systemic pressure. It is not driven by price movement, it is driven by constraint. At the same time, external actors were watching closely. Sovereign buyers, industrial consumers, and long-term asset allocators monitor these events not for headlines, but for signals. They are less concerned with short-term price volatility than with reliability. Reliability is the currency of infrastructure. When an exchange demonstrates that physical settlement can be constrained under stress, it changes how participants allocate capital. They seek redundancy. They diversify venues. They prefer arrangements where performance risk is minimized. This shift does not happen overnight. It happens incrementally, but once it begins, it rarely reverses. The silver market occupies a unique position in this context. It is both a financial asset and an industrial input. It cannot be replaced easily in many applications. Supply disruptions have real economic consequences. That dual role magnifies the importance of settlement integrity. For industrial users, the risk is not price spikes alone. It is delivery failure. Production schedules depend on material certainty. When certainty erodes, inventory hoarding increases, further tightening supply. For financial institutions, the risk is reputational. Markets operate on trust that contracts will be honored as written. When that trust is questioned, participation declines or shifts elsewhere. The delivery demand placed both risks on the table simultaneously. Internally, decision makers had to assess not only how to meet the immediate obligation, but how to prevent a cascade. Preventing a cascade often requires discouraging imitation. That means sending a signal, subtle or overt, that similar actions will not be rewarded. This is where market intervention often appears. Interventions are rarely described as defensive. They are described as stabilizing. But their purpose is the same: to protect the structure from behavior that exposes its limits. The suspense in this situation did not come from uncertainty about what might happen to price. It came from uncertainty about how far the system would go to preserve itself. Would it absorb the cost quietly and hope no one noticed? Would it alter rules incrementally to slow further pressure? Or would it take decisive action and risk public acknowledgement of strain? each option had implications far beyond silver, because once an exchange demonstrates that settlement can be constrained, participants begin to question other markets built on similar assumptions. Confidence does not collapse all at once. It migrates. That migration was already underway. The delivery demand did not force an immediate outcome. It forced a choice. And in systems built on leverage, choice under constraint is where structure is revealed. By the end of the settlement window, the market would know which path had been taken. But by the time that knowledge became public, the most important decisions would already have been made, quietly, internally, and irreversibly. The warning that outlives the event. By the time the settlement window approached its end, the most important outcome had already occurred. It was not a price move. It was not a headline. It was a shift in understanding. Markets do not fail when prices move sharply. They fail when participants stop believing that the rules will be honored under stress. This event placed that belief under pressure in a way few others had. The demand for physical settlement forced a question that could not be avoided. What happens when paper claims confront physical limits? For decades, commodity markets have operated efficiently because they rarely had to answer that question. Liquidity masked constraint. Leverage masked scarcity. Confidence masked exposure. The system worked because it did not have to prove itself. This event required proof. From a global perspective, the implications extend far beyond a single commodity. Modern financial markets are interconnected by shared assumptions. One of the most important is that settlement risk can always be managed without disrupting price discovery. When that assumption is challenged in one market, it invites scrutiny in others. The historical parallel is not exact, but it is instructive. In earlier monetary regimes, convertibility existed on paper long after it became impractical in reality. The gap between promise and capacity widened quietly until a single action forced alignment. Those moments rarely arrive with warning. They arrive when someone chooses verification over convenience. The silver market sits at a strategic crossroads because it connects financial abstraction with industrial necessity. Unlike purely monetary assets, silver must be delivered to function. It cannot be substituted indefinitely. Supply disruptions are not theoretical, they are operational. This dual nature amplifies the consequences of settlement stress. As institutions evaluated the implications, attention shifted from short-term resolution to long-term positioning. The question was no longer whether this delivery could be met. It was whether future reliance on the same structure made sense. Trust, once questioned, does not return through reassurance. It returns through redundancy. That redundancy takes many forms. Alternative venues, direct procurement, bilateral contracts, physical stockpiling, reduced exposure to leveraged instruments. Each adjustment is small on its own. Together, they reshape markets. This is how power migrates, not abruptly, but persistently. Geographically, the implications were equally significant. Markets that prioritize physical settlement over paper efficiency gain relevance during periods of stress. Markets that emphasize liquidity at the expense of delivery assurance lose influence. Capital follows reliability. For business leaders, this moment served as a reminder that price is not the only variable that matters. Availability, certainty, and control often matter more. A lower quoted price is relevant if supply cannot be secured when needed. For investors, the lesson was equally clear. Exposure without settlement consideration is incomplete. Assets that rely on counterparties perform differently under stress than assets that do not. This is not an argument for alarm. It is an argument for realism. The delivery demand did not signal the end of the system. It signaled the end of complacency. It showed that assumptions long treated as safe could be tested by rational actors pursuing rational goals. Importantly, the actor in question did not need to reveal identity or intent. The action alone carried meaning. It demonstrated that physical settlement is not obsolete. It is merely underutilized. Once underutilized mechanisms are activated, they change behavior. In the weeks that followed, the most consequential responses did not appear in price charts. They appeared in balance sheets, procurement strategies, and risk frameworks. These changes rarely make headlines, but they define outcomes. Supply chains adjusted, inventory targets shifted, contract terms were revisited. None of this required public acknowledgement. It required foresight. This is how strategic warnings function. They do not demand immediate reaction. They demand preparation. The suspense surrounding this event did not lie in uncertainty about the next price move. It lay in uncertainty about how many participants would internalize the lesson. If few did, the system would stabilize temporarily and continue as before. If many did, the structure would evolve. Evolution, not collapse, is the more likely outcome. But evolution has consequences. It reallocates advantage. It rewards those who recognize constraints early. It penalizes those who assume continuity without verification. The silver market may appear small relative to global financial flows, but its signaling value is outsized. It sits at the intersection of finance, industry, and geopolitics. Stress there is informative. In that sense, the delivery demand was not a disruption. It was a disclosure. It disclosed the cost of convenience. It disclosed the fragility of leverage. It disclosed the importance of settlement in a world that prefers abstraction. Most importantly, it disclosed that systems built on trust must occasionally be tested to remain credible. For those watching closely, the warning was clear and unemotional. Do not confuse price stability with structural stability. They are not the same. The market did not announce this lesson. It demonstrated it. And demonstrations, unlike narratives, cannot be ignored indefinitely. As time passes, attention will shift elsewhere. New data will dominate conversation. New events will claim focus. That is how markets move forward. But the implications of this moment will persist quietly, embedded in decisions made long after headlines fade. That is how strategic change occurs. Not through drama, not through prediction, but through constraint revealing truth. Those who understand this do not need certainty about what comes next. They need awareness of what has already changed. The delivery demand was not the conclusion of a story. It was the opening of a new chapter, one written not in prices, but in choices. And in markets, choices under constraint are what define the future.